Hello traders and welcome to today's event. It is January 31st, the last trading day of the month, and man, do we have a packed calendar. Lots of economic releases, earnings releases, and we have the FOMC meeting that will be starting in about 2 hours. So we're going to make this session about an hour and 15 minutes or so. There's no defined cutoff. Please make sure to post your questions, and as always, I like to start out with a review of the previous picks that we've highlighted. And my most recent picks have been JPM, and this is approximately where the live event was last week. I had mentioned that I like the D1, how the stock had been able to recover after that earnings drop. It had been able to get back above AVWAP-E. And you can see that was an awesome pick. And I'm going to knock through a couple more here. I know AMD was one that I highlighted. I believe that might have been in the last two events ago, and you can see the big run up there. You've got to be taking profits, and you know I've been encouraging that. And then finally, last Sunday's video, NFLX was one that I liked. Netflix. Whoops, sorry about that typo. Netflix, I got an alert this morning, and it was the LRSI cross on an M30 basis, and it has just gone bullish. We're looking for a little bit of a pullback, and ideally, we'd like to sell an out-of-the-money bullish put spread, but when that LRSI M30 alert triggered, we wanted to see what was happening with the market. Obviously, with the market pulling back like this, there is no reason for us to take bullish trades right now. We want to see how deep this market pullback is. So, Harry, welcome. Thanks for joining us, and let's give you a shot at some of your picks. Harry's video isn't showing up just yet, but he's working on it.
All right. Thank you, Pete. Hi, everyone. Yeah, sorry about that. Just having some camera issues. So, yeah, last week, I believe, memory serves, I said my pick was Google was one. I told everyone to sell that before earnings. I made that clear. I know I played Google on earnings, but that's not for anyone else to do. And as you could see, Google, when I said everyone should grab it last Wednesday, was at around 148.50. And if you sold it before earnings, you would have sold it at around 152. So you would have made $4 on that trade. And then AXP was another one I mentioned. And AXP had a great run up here and a nice boost off of comparative earnings. So AXP, when I mentioned it, was at around 188. It's now at 203. So that's another $15 gain there, keeping the streak of profitable picks alive. And right now, I am just watching the kind of response. I mean, I don't use terms like oversold and overbought. I don't believe in them because things can be oversold or overbought for quite a long time. But it's interesting to see the reactions here. The numbers, as Pete, you mentioned in the chat room, the numbers on the earnings last night were good. There's no way around it. I mean, maybe a little light on the advertising side, but overall, these were good numbers. But you've had a hell of a run up going into these earnings, meaning that if you want to have a strong positive response, at least initially, you're going to need numbers that just aren't good, but numbers that blow away expectations. And nobody has yet blown away expectations. Will Meta or Amazon do it? Maybe. I mean, if advertising is a little low on Google's side, it's going to be a little tough on there and to defy that. But you really need to see when you have these strong run-ups into the earnings number, and a lot of people post, I don't get it, the earnings were great, and yet the stock dropped anyway. Well, it kind of makes a mockery of the idea of expectations, right? Because you would think, well, if it's priced in, then expectations would go up, but that's not the way it works. It really isn't. You really have to blow away expectations when you have a strong run up into the number. And almost every one of these stocks have had a strong run up into the number.
Yeah, exactly. And you and I have been very vocal about this for weeks. We've already been looking out to where is that next window of opportunity? Where is all of this news going to converge? Oh, gee, we've got Amazon reporting tomorrow. We have Apple reporting tomorrow, Meta reporting tomorrow. We have the FOMC statement today. We had AMD and Google and Microsoft yesterday, and we've got the jobs report on Friday. You couldn't pack more information into a 3-day period if you tried. And so heading into all of this, you can see how there have not been any major dips or pullbacks. We got one tiny one, the first 4 trading days of the year, that was erased with one long green candle. Folks, this is very, very bullish price action. So we've been expecting the market to float higher. Why? Well, if you are a short seller and we have a new all-time market high, do you think you're going to be very aggressive heading into major news events like this? Of course not. Are you going to be aggressive when you've got the mega cap tech stocks that have been fueling the entire market rally for the last few years? Are you going to be short into those major earnings announcements? No, you're not. You're going to wait for those earnings announcements. You're going to wait for the Fed, and then you'll decide if you want to start getting more aggressive with your shorts. So what we're seeing today is normal profit taking, and the fact that the earnings expectations were so lofty, they delivered, they were really good. So this is not a major pullback where we can expect to see long red candle, long red candle, long red candle. This is going to be a normal run-of-the-mill dip in a bullish market. So you can see the tiny bodied little dojis here and the light volume float higher. This is because shorts are very passive and the long-term investors are not selling. So even a small bid can fuel this market rally. And I've been urging you to take gains on your swing positions Monday and Tuesday before these big events come out. And I believe the FOMC is going to be a splash of cold water. I'll give you my take and then we'll see what kind of how Harry feels about all of it. But we've had this big run up and everyone's looking for the Fed to cut rates soon. And I don't believe they're going to. They're not compelled to. They've got lots of breathing room. Jobs are good. There are no credit issues. Inflation has been persistent. So they want to make sure that they get it right this time. And there's no pressure for them to ease. The economy is not faltering. We have very strong GDP growth of 3.3%. So I think the Fed is going to say as much, and the market's not going to like it because it's addicted to easy money. Is that going to cause a massive panic sell-off? Oh my God, the Fed's not doing anything. Sell. No, it's just going to be a little bit of profit taking that flushes out some of these bullish speculators. We find support, and then we are waiting to reload. So that's how we're playing it.
Yeah, I think I said earlier a month ago or so that this year is going to be all about rate cuts, and you're going to hear likelihood of rate cuts, how much they're going to cut, and Powell's going to come out there and with steely blue eyes and mesmerize the audience as usual today. Look, I mean, everyone gets a little bit ahead of their skis saying there might be rate cuts in March. I don't think there will be, but again, you never know. I mean, the thing is, as long as the economy is doing well and inflation is coming down, there is no reason to cut rates, right? I mean, there's just why. In fact, keeping rates at this level kind of guarantees that inflation won't return. However, when you start getting and start seeing some signs of slowdown or not disinflation, you start seeing signs of economic slowdown or lack of job growth, then you have incentive for rate cuts. And so it's sort of 6 to 1, half a dozen of the other, where in order to get the rate cuts accelerated that the market wants, you need to have a deceleration in the economy. Deceleration in the economy tends to lead to poor earnings reports in the company. So it goes back and forth. The best case scenario here is kind of threading the needle that this economy has been threading, which is the economy stays strong, inflation tamps down, and they're able to start slowly cutting rates down to a, I don't think you'll ever go back to the zero free money days, but, down to a normal level. And at the same time, you don't need to have these dire economic, news drops to do it, that they can cut rates without having to see the economy take a dive. And I kind of think that is the economic needle that we're threading. And I've said before that economic books are going to be rewritten when this is all said and done, because nothing worked the way they thought it would work. Technically, you raise rates the way they raise rates, and the speed in which they raise them, you go into a recession. It's as simple as that. And unemployment goes up, you go into a recession, and the recession helps take care of inflation. That didn't happen. In fact, unemployment went down. Unemployment number dropped as rates went up. That is unprecedented. That's literally never happened. So a lot of things kind of worked in reverse. And you're going to have, the number of PhD theses that are going to be written explaining why it happened, I'm sure will be numerous. But either way, what we see is the market responding. All-time high. It's interesting. You look at Main Street, and they always talk about that disconnect, and people tend to say, well, Main Street has a better pulse in the economy than Wall Street does. Well, this time it's the opposite, where Main Street has a negative view on the economy, and you look at the all-time high in the stock market, and that is actually a lot more reflective of the state the economy's in. So again, reversal.
Yep, I agree with everything that you said, and I've got the QQQ up so you can see that chart right here. You can see how it's pulled back pretty considerably. Now, QQQ did not float higher like SPY did. You can see how it was compressing. So it was a little bit weak and a little bit tired this last week, and you can see how now it's kind of pulling back. But I'll put the SPY up. One thing that is also surprising is that our economy has been so dang strong when that's not the case globally. And that is one of the things that our market is going to be fighting. Is Europe just came out with their growth numbers, and GDP for Q4 was flat, 0% growth. Q3 minus 0.1%. If they would have come out with a negative quarter, then you would have heard recession. Well, if you're ticking, positive and negative 0.1%, who cares? It's not, that awful, but that's flat growth. Where is the growth going to come from? And we also know that there are issues in China. So possible credit issues. So yes, the market climbs a wall of worry. I think the US markets to a degree are benefiting because we are the best game in town right now. Our market has recovered, don't have credit issues. Our economy has been strong. So we're going to continue to follow what the market is doing right here. And the reason that we like taking profits when we have these run-ups, as I've been mentioning, 2 steps forward, 1 step back, 2 steps forward, 1 step back. Well, the steps back haven't been 1 step back. It's been like not even a half a step back. We haven't seen any real dips. This is the first bullish flag formation here. I'm looking for another one right now. And where might we possibly pull back to, and how will we react to that pullback? Well, if the pullback lasts a week, 5, 6, 7 days, and we are well above the AV-WAP-Q, that is a sign that we are going to continue to go higher. So a little air got let out of the balloon after earnings. The Fed splashed a little bit of cold water on us, and now we're flushing out these bullish speculators. And then somewhere, let's say around the 480 level, the market finds support. Okay, well, that's where we're going to reload. And because the dip is short and brief, we can be more aggressive with our longs, meaning you might want to buy out of or in the money calls with a very high delta of 0.7, go 2-3 months out and trade in that fashion. Now, if we do pull back and the dip lasts, say, 2 weeks or so, maybe even a little bit longer, and we start testing this AVWAP-Q and we are testing this horizontal breakout from back a couple of weeks ago, then we need to be a little bit more cautious because we know that the selling pressure is starting to increase. And then we would be favoring selling out of the money bullish put spreads. If that scenario plays out, option IVs will be higher, but we are still neutral to bullish at that stage, and we'll be looking for the market to grind higher and to challenge that high. So that's how we play it. And by being on the sidelines at times, or at least having your risk pared back to where you can tolerate and weather these types of pullbacks, when conditions finally stabilize, you're in cash, you're in control, you're ready to deploy that cash, get back in the game, and you're able to evaluate that dip, the duration and the magnitude of that drop. And as soon as you see the depth and duration of it, then you know what to expect on the upside and how to trade it.
Let me just deal with so in a chat room here on YouTube, Zachary Delilah, amateur economist, says, economy isn't doing well, you fool. Ha, ha, ha. You serious? Ha, ha, ha. Evergrande is going to crush the world. All Ponzi's come to an end. Brilliant. Brilliant analysis. Well, Zachary, we can only look at what we've always looked at, which is indicators that the economy is doing well. Jobs report, unemployment, the GDP, small things like that that actually show how much money the economy is making, how many people are working, how wages are doing, all of that. There's small little minor details that I'm sure in your conspiracy-addled mind mean nothing. But all of those are at historic highs, or in the case of unemployment, historic lows. There is no doubt, in fact, inflation is at pre-pandemic levels. So no matter how you look at it, there is not one number you can point to that would suggest the economy is doing poorly. In fact, every single number shows the economy is doing extraordinarily well. As for your Ponzi's must come to an end, I can't even imagine, nor do I care what you even mean by that. And if you think that you have deeper insight into the situation in China than, I don't know, every single major institution here, well, I suggest you start your meetings at JPM and Goldman and tell them what's what, because clearly they're in the dark, and you at altreality.net conspiracy site clearly know the truth. Go to the grocery store. How much higher is your bill? How many people are being laid off? Again, there are unemployment numbers. People register for unemployment. They get unemployment checks. There are jobs numbers. When companies have jobs openings, they post those. Those are very, very clear. You see, there is no scam there. There's no conspiracy there. There's no way to hide that. What's incredible to me is that you wake up every morning and your brain allows you to breathe. Because, oh my God, how idiotic and arrogantly idiotic do you have to think that because you go down to your local grocery store and say, oh, wow, I pay now $50 or $100 for groceries this week, that means the economy is crap. Do you have to take that and go, oh, we're heading to the depression, the economy is bad? The level of immense stupidity continues to astound me. Sorry, I go off on these rants, but it's not just the stupidity, it's the confidence. in which these stupid people actually express themselves because they read something online that they think they have unique insight into. The only thing you have unique insight into is why you didn't finish your GED. So do yourself a favor and try to stop just for 1 second of being a know-it-all troll and actually believe that, well, maybe, just maybe, there are people out there that know what the fuck is going on and I don't. Rant over.
Well, I'm going to cover the GED aspect of it first, because there are very many intelligent people who have PhDs and MBAs like myself who think that they know it all too, and they can analyze the economic numbers and predict what the market should be doing. And that just gets you into trouble because you don't know what the institutions know. They have research teams, they have boots on the ground, they know every little supplier for an Apple iPhone, and they do channel checks to see exactly how many of those are being produced. So they have boots on the ground. Their information is superior to ours. Our effort is to find those breadcrumbs and to follow what they are doing, but not to try and compete with them on a fundamental basis. So, Zachary, we were looking for a major market bottom here, and we bought 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 here, and now we're taking some profits. How did you do? Probably not as well as we did. So sure all your wisdom, you're sitting on the sidelines, worried about China and every other thing. Technical analysis is what we lean on. That tells us what the money is doing. And I'm not saying that any of those may not manifest into something that we do need to be concerned about. We are going to see that reflected in price because the institutions are going to be selling. They're going to see the warning signs too. And as soon as they start getting out of positions, what do we see on the S&P 500? Long red candle, long red candle, long red candle. Uh-oh. All right. Now we know that the momentum is starting to shift, and then you'll get a little bounce and a lower high double top. Okay, now we can start taking some short positions with confidence, but not before then, and certainly not into this kind of strength. And I know personally, because I've read a lot of comments when I told everyone right here that we were going to see a little bit of a dip, but to be patient with longer term swing trades, that it was going to bounce right away. In here, everyone was, oh, so worried. Oh my God, the market just doesn't look as good as it did. I'm kind of worried. Maybe we missed something. Maybe we're going to roll over. Don't take my word for any of this. Go back and watch the live events from 2-3 weeks ago, and you'll see exactly what I'm talking about. And then you get this nice breakout to a new all-time high, and everybody's like, oh yeah, that was easy. Yeah, there was no worry in here. Right. Okay. Well, emotions are going to impact your trading in a huge way. So now that we had this run up and now that we have major news coming, this is a prudent place to take some gains. See how it plays out. Even if we didn't get a pullback, at least we would have had more information and we could have joined the breakout with a greater degree of confidence. But we're getting the pullback, which is good. Now we're going to have a better re-entry point, and we're going to be waiting to see how far we pull back. How deep
and this is a general mindset issue that causes counter trend trading, which is what you're touching on here, and why so many traders, even though they might know technical analysis and they might see all of the levels of support, and they could have that down pat. They could have it perfectly lined up and know it front and back, just like you can know the rules of chess or poker or any other type of game like that, and still get it wrong because in their mind, you know, if you have the mentality, well, it's all bullshit and the economy's not doing well and blah, blah, they're lying to us, then what you're waiting for is for, oh, we're going to collapse. The market's going to collapse. It's just all being inflated. It's a Ponzi scheme or whatever. And so what you start doing is you start trying to time the market. You start counter trend trading. You short the market up here. You're going to short NVIDIA at 510, 550, 600, 620, and continue to lose each and every time. You're going to continue thinking everything's overbought. These are, all-time highs. And what you're doing is you're trying to beat the market. What you're really doing is trying to solve this whatever deep-seated mommy doesn't love me childhood issue of I stand out. I know better. I am the special kid because everyone was saying it's going to do this. I was the only one standing there saying, no, no, no. It's all a scam. It's going to drop. So I bought these puts and look at me. I won. And then guess what? You didn't. You didn't win. You lost and you lost and lost and lost. And you keep losing until you run out of money. And then you cash those welfare checks and you put some more money in. And guess what? You lose that too. Then you borrow money from cousin Timmy and you lose that too. Until eventually you're turning tricks in an alley. So do yourself a favor and trust the damn price action and stop trying to pretend you're smarter than the institutions that are driving it, because you're not. This is fun.
Okay, so I've got a question. Patrick says, I'm scared of the FOMC. What can I do? Take the chips off the table. Go to cash. That's what we've been telling you. You don't hedge I don't like to hedge. I'm going to write an article on it. I am scaling my positions to match what my level of confidence is in the market and my level of confidence in the stock. And if that confidence starts to wane, I reduce my risk exposure. I do not start adding a bunch of hedges. And hedges are expensive and they oftentimes don't work. So in a market like this that's been running higher, you could have a short or two on if there were extreme relative weakness, but those stocks are fairly hard to find. And so you could hedge yourself a little bit that way. I still prefer, if I'm taking a long or a short, and I'll day trade it either side at any time. Doesn't matter what, the market looks like. If I see the right short or long, I'll take it. But your balance is always going to be swayed to the long side when you get a market run as we currently have. If I am swing trading, I'm going to be paring back my overnight risk exposure so that if I get big events like this, I could have very negligible long-term market exposure. And then I wait to see, what did the FOMC say? They're not going to say anything different, by the way. It's just going to be a reminder of higher for longer. And that's not market friendly. It's not what the market wants to hear. So we get a little bit of a pullback, but nothing is going to have changed materially in that statement, and nothing is going to change materially with regards to the market. So I would view any little pullback as an opportunity, and we won't know until we see it where that support is established or how we might establish our next longer positions. But that's what you do into these major events. Take risk off the table. And I don't trade binary events either.
A stock specific alert. Goldman, I put an alert, a perfect alert here at 394, because if you take a look at the Goldman chart here and there's a beautiful trend line here right at the top of 1214. You just connect that to 1215. It connects again to 1228 and again to 12, again to 15, again to 18, even again to 122. I mean, you have 1, 2, 3, 4, 5, 6 touches on this line. And then again today, 7th touch today on this line. That line comes in exactly at 394, which is roughly the high of the day today. And that trend line, which would also break Goldman to a new high, a high of the year, certainly. And I think it's going to be a high since probably way back in early 2020, late 2021. 394. If Goldman breaks 394 and confirms above it, and that trend line is so strong that the break above it, you're not going to need tremendous confirmation, because just the simple act of breaking that trend line is going to take some volume and some strength there. But once that happens, and you get even the simplest, most basic confirmation, I really like Goldman for a long. I'm waiting for that trend line to break those, so I am not going to just jump in on.
I had a question. How much higher can JPM go? Well, for that matter, how much higher can the S&P 500 go? We're in no man's land, uncharted territory, new all-time highs. Well, you watch price action. So I'm not going to sit here and tell you, well, based on Fibonacci calculations here and measured moves, blah, blah, blah. You watch what happens to the price action, and you start having a big run up like this. And then all of a sudden you start losing this momentum and you get tiny bodied candles like this. That tells you that there's resistance building. Wham, 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 wham. It's not advancing because there are profit takers in there. The same thing would be true of JPM. So as the stock continues to move higher, and when it eventually starts to level off and you see these tiny bodied candles in very light volume, then you know it's prudent to take profits. But as long as it's stacking nice green candles like this, there's no need to get out of it. You can expect a compression along the way in here. The other warning sign would be a big gap up. Pretend that this is not an earnings date. A big gap up to a new relative high and a long red bearish engulfing candle or a long red bearish hammer. Ding, 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 ding. Warning sign. Okay, you don't have to bail instantly and immediately, but you are on high alert to exit as best you can. So any little rally from that point on, you're out. If you follow up with a red candle, you got to be out. So those are your warning signs, and just keep following it higher. By the way, I would not be long banks into the FOMC or anything else. Wait to see what the dang reaction is.
So on here asked, are you familiar with Ripster's clouds, specifically the 512, 3450 EMA clouds? Nice visualization for the following the daily trend. Well, Ripster's clouds, like the Ichimoku clouds, are aggregate indicator. And so basically there's two types of technical analysis indicators, really. There are the types that, like, let's say the 200-day moving average, right? It's a simple, basic calculation. There it is. It works. Why? Because institutions pay attention to that number. That number is built into their algorithms. That number has meaning because it's given meaning by the widespread adoption of it. So since every institution uses that number as a level of support or resistance, it inherently becomes meaningful as a buy-sell area. Then you have these indicators that will combine all of these numbers together to produce for you an image or a trend to show you, again, where they think levels of support and resistance are. The Ichimoku clouds are one of them. Ripster's clouds is a much less used one. I think memory serves, the Ripster's cloud uses volume and some momentum indicators like MACD and RSI to also calculate, whereas Ichimoku is more focused on the moving averages itself. Look, these are all just visualizations of support and resistance, right? And you can tinker with the settings. The problem with them is that they aren't widely used. So JPM and Goldman and all of them, they're not sitting there looking at Ripster clouds as to where their level of support and resistance for buying and selling is. And that's what those things mean. All support and resistance is where is the majority of the liquidity for the market for this stock going to make a decision as to buy, sell, whatever, hold. And the more widely used they are, the more important they are. So when you get esoteric like this with these Ripster clouds, you might get a visualization because it's combining widely used indicators. But the problem is that the moment you start tinkering with them, like you're using the 34 and the 50 EMA, nobody uses 34 and 50, right? So that just becomes more of a trend indicator. And the trend itself might be correct, but there are much simpler and easier ways to visualize the trend and the levels of support and resistance for a stock or for the market in general than getting in detail, because there are hundreds of the ripster clouds, and yes, I'm using air quotes since you can't see me, out there, but I've never found them any more or many times far less helpful than your basic moving averages, your EMAs, things like that. So I would not use it or pay too much attention to it unless you just simply like a visualization tool to let you see the trend one way or the other.
So I had a question on how do we know when support is in for the SPY if we do get a pullback on the FOMC? Another question was what happens if we don't pull back on the FOMC? So let me address both of those. When you read price action, it's the same across all time frames. I don't care if you're looking at a 5-minute chart. I don't care if you're looking at a 1-hour chart, a daily chart, a weekly chart, the same principles apply. And so, for instance, today we get this big gap down, and this gap right here, because we didn't make any effort to fill it, like stack green candle, stack green candle, stack green candle, fill in more than half the gap. Okay, a gap reversal is off the table. We're not going to see it. And I could tell in the first couple of bars, what's going to happen? So we get this long red candle, takes out the low. We know that we've got some additional selling pressure coming. And now we cannot even retrace into that red candle. So we just continue to drift lower. And in here, now we start to see at least some signs of support. So we're not drifting lower. We've got some tails under body here, a little bit of a bounce. This is a double bottom. This is what you want to see, particularly if the price action on the way down has been very fast and furious with lots of red candles. You need that confirmation. There will be times when the dip is very brief and shallow where you get a quick pullback for maybe a week like we talked about, and then all of a sudden buyers are just back. And so the market never really got any traction on the downside, just like here. You got some tiny little bodied red candles, nothing much, intraday, tails, wicks, so a lot of compression, and then boom, buyers are back. That's what you want to see. If you see this, stacked red candles, you know there's some selling pressure that's got to be worked off. Eventually, when that low is in, you're going to see a nice bounce off of that low. So that's what we'll be looking for around these support levels. Horizontal support right in here was resistance, now support. Use the open of that candle, which is 477.65. That should be a support level, and it kind of coincides with the AV-WAP-Q. I don't believe we're going to see any of the major moving averages come into play. Let me put the 50-day up. You can see that's down around 470, let's call it. I don't think those are going to be in play because of the strength that we've seen so far. So I believe I'm not looking for a gangbuster rally either. Just looking for this upward momentum to start slowing gradually, but still upward bias. And if we don't get any kind of pullback on the earnings this week and the FOMC, the jobs report comes out decent on Friday, then I think you're going to get that really shallow little pullback, and then you should be looking to reestablish your long positions, because I don't see any other dark clouds on the horizon that are going to spark a lot of profit taking. Interest rates and earnings and credit, those are the things that drive the market. And if interest rates are possibly going to be cut, they're at very least paused. There's no rate hike. Earnings have been excellent so far. If they continue to be excellent and there are no credit worries, market has what it needs to move higher.
Let me do a power run through some of these questions here. Okay. Gizmo, win rate 70%, paper trading, shares 1-to-1 risk. Should I keep focusing on getting that win rate up while trading normal shares to try options? And scaling account, same person, better to try to learn options for leverage, try to get funded once you've proven consistent profitability trading over a fairly long time. I outline in the wiki the step-by-step. I recommend you need to have 3 consecutive months of a win rate over 75% and a profit factor of 2 or higher before moving on to actually funding your account and then trading only 1 share after you fund your account and duplicate those results while using 1 share in live trading. Only after you've done both of those, which takes a minimum of 6 months. That's if you get it perfect. 3 months straight win rate, 75% profit factor 2 on paper trading, and the same thing on the stocks, 1 share at a time. Should you then consider branching out, funding your account, going more into options? Look, there's different ways to think about this. Win rate by itself is not important, right? You can have a 50% win rate and be profitable. The reason I say you need to have that is because you need to know the methods like the back of your hand. And you need to get to the point where it's almost muscle memory that you're doing it. So that's why those benchmarks are in there. Once you get into that point, then you can start taking higher risk reward trades, have the lower win rate and still be profitable. But first you have to go over those hurdles. So until you went over both those hurdles, I would not consider scaling up or expanding. What's my opinion on the U.S. Investing Championship? I have no opinion on it. As far as I'm concerned, I win. Until someone can show me a more profitable trader out there, they can win all the trophies in the world they want. But it looks fun, the tournament style and all that. But at the end of the day, who cares? What I care about most is how much money goes in your bank account at the end of the day. And, those people might do well in those competitive environments and probably don't do well in straight trading environments. But again, fun to watch. It's not like a sport, whereas if you watch a dart championship or a poker championship, usually the people who consistently come on top are the best in that field. That's not necessarily the same in the investing championships. Scale back my long position, Marvel. Like Marvel, I have 43,000 shares of it. That's going to be part of Wiki 2.0. I have a combined technical and fundamental thesis on Marvel, so I am not scaling back. And then finally, for spreads, is it better to have narrower strikes better than wider strikes? It doesn't matter. As long, for example, if you're doing a debit spread, and you're doing an at-the-money debit spread, you want the debit you're paying to be less than 50% the distance. So if you have a $5 distance between your strikes, you don't want to pay more than $2.50. It really is just a matter of there's no difference inherently in paying 25 cents for a 50-cent difference in the strikes and getting 10 of those, or getting one of a $2.50, $5 spread. So it's just a matter of the size. But in terms of win rate likelihood, the distance between the spreads, whether it's 50 cents, $1, or $5, rarely matters. You just want to have, if you have stocks like, Goldman or Nvidia that tend to make larger moves, you can have wider spreads because you know that if you're directionally correct, those spreads will be covered. I think I got it all. AVWAP is not a proprietary indicator. Look it up. It's a fairly well-known. You're anchoring VWAP. Pete wrote an entire article on that. I suggest you check it out.
One quick note on AVWAP in the new version, which I am using. You'll also notice some of these colored bars that you can define how much above average volume you'd like to see, and that average volume calculated over what period of time. You can define that. You'll also notice this little anchor icon. So if I want to click it and set my AVWAP here, that line will automatically draw. So it's another nice feature that we've added. We had a number of symbols that people were asking about, and one of them was MDT. I'm on Green Royal Flush, so that stock has certainly been on our radar. Really nice breakout here today. Market down, stock gaps up, preserves the low of the day, continuing move higher. Get a bullish FOMC reaction. Yes, this would be a stock that I would be looking at. On that list also was RTX. That's also on our list. Daily chart. Looks really nice. You can see this horizontal breakout through resistance. You can also see how the stock gaps higher after earnings and compresses. It's digesting these gains, and buyers are getting more aggressive. AVWAP-E is holding, and now the stock is making a new relative high on a closing basis, at least where the last is. And I like it. Yeah, I think both of those stocks look good, but it's not going anywhere fast with the market pulling back. So I like both of those.
Let's see here. If we're looking for a decent short on the day here, someone asked, how do you trade a day like yesterday when SPY was just, I mean, that's a low probability trading environment, right? So, for example, I took $2 off Apple on a day trade because the news hit. I saw Apple drop. I grabbed $2 and then I was out. On days like that, I will look for standout stocks like Apple, for example. In that moment was a standout moment. Stock just took advantage of it and then quick, and then you're out. Rather than I'm not going to get much help from the market there. Whereas on a day like today, where SPY is still unable to get above VWAP, you can really start looking at some potential shorts that you might want to take. Again, only as a day trade. I would not carry shorts over. On a swing basis, I would be as close to cash as possible, particularly because any one of these earnings reports can flip the market around. You can have an incredible Qualcomm tonight. Tomorrow, especially with Apple and Amazon and Meta, those themselves can turn the market. So you don't want to be sitting there with a bunch of shorts and then all of a sudden, fuck, I'm screwed, right? That's obviously not a good position to be. Do I like SoFi as a stock? It had great earnings and is now profitable for the first time ever. Yay, SoFi. It's a good thing you're profitable. It's the whole point of business, isn't it? No, I don't like SoFi at all as a stock because you need to look at the daily chart. First thing you should do, period, always, full stop, look at the damn daily chart. Put on your daily chart minimum 3 things: the 50, the 100, and the 200 SMA. Just those 3 lines alone. That's it. But you have your volume, you have the SMAs. Keep it simple. Start that way. Okay. Now, where is SoFi? It is currently dancing between the 100 and the 50. It's not breaking below the 100, and it's not going above the 50. 2 days ago, it was above the 50, and then bam, back down again today. It is an $8 stock with a 55-cent ATR, and it's going nowhere. So until you see this stock get into the gap, which is going to be confirming above $9.03, and when I'm starting to talk about 3 cents, it's probably not a good trade anyway. I would avoid it. Now, I know what you're thinking. It's only $8, and this stock used to be up at like $30 or $24. What if I buy it now at $8 and it goes to $24? Okay, then buy it. Great. If you have that great of a fundamental read on the company, technically, I'm telling you, as a day or swing trade, SoFi is not good. You want it for a long-term investment, knock yourself out. If you have that good of a read into the fundamentals, then there you go. But unless a stock is clearly above, those SMAs are clearly below it, avoid it.
Yeah, and those questions typically come up from people who are trading and who read something good. Gee, I just read the earnings report. Now, gee, I just read about this analyst who really likes the stock. And what do you guys think about it? We use technical analysis, period. I speak for myself because Harry actually does do fundamental analysis and has access to some really good research. I use technical analysis. And so I get paid when I predict price movement. That's how I get paid. And this chart right here is all over the place. Look at how choppy this thing is. There is no rhyme or reason to it. You cannot look at any point in this chart and tell me that you know definitively what that stock is going to do next. And so if my job is to predict price movement, I might as well be trying to predict the flight of a bat. Okay? It's all over the place. I can't do that. I want to try and predict the path of a flock of geese that are in V formation late in the fall. I think I got a pretty good idea of where they're going to be heading. And so I would prefer to take a look at a stock like JPM. Do I think I can predict where this stock is going? Yes, I think I can. Well, that's what you should be focusing on. Forget the rest of this stuff. But when people see moves like this, they get very nervous. Oh gosh, it's made such a good run. It can't go any higher. The price action is telling you what the institutions are doing, and it doesn't dip because every seller is met with buyers. They want more. They want more. How many more you got? How many more you got? That's why the stock never has a pullback. This is a super strong move. That's what you want to be looking for.
Oh, you want some technical analysis? Don't buy into this Paramount, Byron Allen buying it. I know Byron Allen, he's a fucking nut job. He's offering like $28 a share. I'm telling you right now, he doesn't have the money for that. He's done this like 3 or 4 times before. And so Paramount's jumping on that news. But here's an example where that news is bullshit. I happen to know it's bullshit. I know the players involved in that. And so that deal where everyone's thinking if I buy Paramount now and that deal goes through, it's going to go up to $28 a share. Yeah, that deal's not going to go through. So, you know, sometimes you see these news pops and they're not all they crack up to be. Okay, so let's see if we can find some good trades here. See if I can find something that resembles a decent trade. Okay. There's on the long side, I mean, interesting, early this morning, let me see, how's it doing now? I was looking at Costco earlier this morning. It's below VWAP now, and it is down. So Costco's having that psychological resistance level at 700. It's difficult picking out any particular stock that I could see. I mean, there's the obvious weakness in Google and Microsoft, but again, those are based on the earnings reports. Those could actually reverse. And here's one question that I can answer right now. Relative strength relative weakness method differ from how you would use it in the crypto market. Well, first, Jose Molina, you said Tesla's a good long. I'm not even going to look at the chart. No, it's not. If SPY influences 80% of the stock price movement, how does Bitcoin influence altcoins? SPY has a 40, 50, 60-year history here of these ETFs and how they move the market. You can look at it. You can see when this is up by this percent, the average stock, whether it's in the ETF or not, is up by this percent. It is a well-established trend, well-established correlation, and there's causation in that correlation because a lot of those stocks are actually in the ETF, dragging up others that are also in its sector. Bitcoin, on the other hand, is all over the fucking map. And yeah, could it go to 200 at the end of the year? Maybe it can. I don't fucking know. Any second now, you could have a post from a senator or from from an agency saying they're going to crack down on this or crack down on that, and then all of a sudden it takes a dive. So yeah, look, I don't love Bitcoin. I like selling puts on MSTR simply because the volatility on it is such that I'm getting a very good price to sell those puts. And I'm fairly confident that unless Bitcoin breaks below 38,000, MSTR, which 85% of its company's revenue comes from its ownership of Bitcoin, is going to stay above 500. So I just keep selling those puts at 440, 450, 475, and I take in, you know, whatever it is each month. That's about as far as I'm willing to go on a Bitcoin play. And again, I don't know what the hell you're smoking, Jose, on Tesla being good long, other than, I don't know, rolled up Elon crap. But you're out of your damn mind if you think going long Tesla here is a smart move.
Yeah, it could be longer term, but if you're trading this is a lot of selling pressure and relative weakness. And for this type of drop, we need to see a firm base over the course of a month or so, where we've got nice tests of that support. Yes, there are still buyers there. Yes, there are still buyers there. Yes, they're still there. And then you're going to start to see a series of higher lows, similar to this drop right here. So you get this drop. Gee, Tesla's a good buy right here, right? It's on the 100-day moving average. No. And disregard that bearish explosion alert. No, Tesla still had more room to the downside. Oh, well, here's the first pop. It's a good buy here. It's a good buy here, right? No, we need to see that test right here. And now we have a higher low double bottom. Okay, do we buy here? We could nibble here. We could take a small position when it gets above AVWAP-E. We can add above the 100-day moving average, because we have confirmation. Okay, now it's into the gap here. So yeah, okay, we can buy here. So that's how you approach your trades. But just because a stock has fallen hard does not mean that it is a good buy. Be the second mouse. What does that mean? Well, what happens to the first mouse that goes for the cheese? He's got his head caught in a trap. So no, we want to wait for that support to be defined. Only then and after time can we start to take positions, and we gradually enter them.
Some of these traders would be greatly approved by having their head caught into a trap.
There are a lot of people who got their head caught in a trap today, I'm pretty sure.
Yeah, it might improve their looks. You meant intraday trading for Tesla? Okie dokie. The stock that's currently down 9 cents today in compression, not even in the gap, below all SMAs. What would you do here? Would you go long? Because yeah, it has some relative strength today, but it's not even positive today. So not sure even on an intraday level why Tesla. I mean, it might. It's just there's. It's more like if you flip a coin, you say, I know it's going to be heads. I absolutely know. If it falls on heads, you're like, I'm psychic. Well, I mean, you had a 50-50. I mean, sure. You'd have a 50-50 on Tesla right now if you went long. That's the best I can say on it. Lulu, yeah, Lulu got crushed here. Lulu is a good short at the moment. In fact, shorting Lulu might just, and thank you, Erratic Snail, both for the creative name and for your note on Lulu here. Lulu may be my pick of the day in terms of shorting Lulu. You don't have support until you get to 447. You are looking at a break of the 50 SMA, a very strong break of it here. You have some pretty good, let me see here. I think I have from DPM some news on Lulu. Let's see if I can find it. Lulu. The YIPIT data was positive, haven't gotten much granular, weakness at the open. Okay. So this is responding to some report here, but also it's responding to the Adidas leak of earnings that came out just a little bit ago. So I really like Lulu as a short, and thank you very much for pointing out. That is an excellent example of a good trend, good use of technical analysis, good daily chart to short. If you were to be overly cautious and you were saying, I want to swing that short, well, then I would wait to confirmation that tomorrow is going to continue a downward trend. But day trading, yeah, I really like Lulu short here and may actually take it. But
me too. I like it too. So you've got a pullback, a breakdown of the AVWAP-E. You've got a nice attempt at a rally here when the market was what? When the market was pushing higher, the stock was drifting lower. You get this little bounce in here, still AVWAP-E intact, and now you have that little bearish flag formation here. If you draw a trend line visually there, you can see the breakdown below the 50-day moving average, lots of room down to the 100-day, really nice, solid pick. And let's take a look at the volume. Big volume today. Look at what the stock is doing. It's down on its low of the day, and the market has actually bounced and found support It's well off the low, while Lulu is continuing to drift lower. So love it. Really nice pick.
Yep. Only thing that's stopping me right now, actually, from maybe doing a put debit spread on Lulu, and I'd be looking at the 460, 450 for $3.50 put debit spread here, would be the fact that SPY is right now approaching VWAP, plus the FOMC in an hour. But this is now SPY's 1, 2, 3, 4, 5, 6, 7th, 8th attempt today at getting through VWAP. And if it does, well, that tells me that a bottom's probably in. And do I think that we're going to see a huge bullish run here? Well, no, probably not. But it does tell me that we might start thinking about heading towards that gap if we can break through VWAP. So I'm going to hold off on a Lulu short, even though I love it. I think it's great. But I might be able to get in at a better price if I hold off and I see SPY break VWAP here to the upside. So that's what I'm watching at the moment. I'm watching that right now. It's right on it, and watching to see if there's going to be a clean break here. And so just for those of you who are following along, VWAP is at 487.37 currently on SPY.
As far as a long that I might like, I like RTX. That was a really nice show earlier. I've been watching that. I like the breakout above all the major moving averages, above AVWeb-E. The stock has been able to shoulder all of the selling pressure today, which, by the way, down days like this are phenomenal because that's what allows us to gauge relative strength. And so when you have a day like this, one of my favorite searches is on a big down day. I'll look for, show me a stock that is above the prior day's high, has good option liquidity, and excellent volume and relative strength. It's very easy search. So in the nastiest of conditions, what is moving higher? When I do get that market turnaround, those are the stocks that I'll feel very comfortable buying, even if I'm a little bit early in calling support on the market. They've already demonstrated that they want to go higher. So I haven't decided if RTX is the one, but I do like it. And BSX is also nice, but I would be more cautious on it because it's not a fast mover. It's had a big gap up. I like the price action, very, very good, but I'd like to see a little bit of the range today tested over the course of the next few days. And then I would like to see the stock starting to move higher and to preserve this gap. Then I would feel comfortable. Yeah, RTX is going to be my pick for today.
I like it. I like RTX. Good pick. What VWAP depth am I using? Wow, we're really getting esoteric here. VWAP has a lot of depth today. It just seems a lot of the trading is occurring right around VWAP. If you look at the volume bars and you see where the trading is occurring, there's not much. If you were to do a VWAP standard deviation today, it would be kind of small. So right now we just had it break right through. We're going to wait for that to confirm to the upside, and now is the time also to start seeing. If you're looking at shorts, which stock, like look at Lulu right here. SPY is strong right now. It's breaking through VWAP, but Lulu is not responding to the upside yet. I'm going to be watching that to see, does Lulu continue to be relatively weak? Conversely, I'm also going to be watching which stocks are very sensitive to this. Now, you generally will not get a break of VWAP like this on a day like today unless you're seeing some strength in tech. So that's also where you should be looking to see, are some of these tech stocks that got their ass kicked rebounding a bit on this market rebound here, and that's what's driving it. Is there some natural support forming on some of these, like a Google? And finally, someone said, if the market continues to go up, do I like ASML? ASML is just an incredibly strong stock. And it really has a monopoly on its business model. You can't have a microchip without ASML. To me, I really like ASML if it breaks 885. Breaking 885, I would go long ASML. I need to see that break of compression there. That would be the best scenario for me on ASML. ASML is also great to sell puts on if you can cash secure them, and also doing debit spreads with particularly credit call debit spreads, because ASML tends to move. Look at that ATR on that stock; it's huge.
So if the Fed stays higher for longer, I believe that bank stocks are going to like that news. So you could see strength in the bank stocks. Unfortunately, the higher for longer message is going to weigh on the market, especially given that we've already seen some selling earlier today. There'd just be a little extra push in that direction.
Dave pointed out a stock here to me, Zim. I like Zim. I'm a little concerned about the trend line there on it, but Zim is certainly strong today. I like this break of compression here. I like that it's already filled that small gap, and plenty of room, obviously, to grow. Zim has been on a nice upward trend ever since November. When it hit a ridiculous low of like $6, it's more than doubled since then. But Zim is definitely one to watch. I like Zim. It's a cheap stock. That's one where you just sort of buy the stock and you hold it. So there is that. I like Zim. It's not my pick of the day. That would probably still be the Lulu short at the moment.
That is a nice one. I'll be looking at that one too. This is a nice long-term trend line here, though, on Zim that it is poking through. So yeah, if we can preserve this level today and even move higher from it on any kind of market strength, yeah, I think that's a nice one. That works very well.
Indeed.
You never fade Dave anyway.
No, don't fade Dave. A guy that's got a 90% plus win rate, I tend to listen to. I don't know, call me crazy, but Dave's just he's the Top Gun version of Iceman in trading. The man never wavers. He approaches trading with without emotional. He knows these are the technicals. This is what I do. He studies them night and day, and he makes the most logical trades. And then when on the rare 1 out of 10 times that he takes a loss, he's out, he moves on. But the 9 out of 10 times he doesn't, Dave is always spot on. So he's always experimenting, by the way. As a lot of I'm thinking of writing the Wiki 2.0. A lot of experimental stuff in there. Again, the problem is, as it's always been, you have these people who are able to take some of those methods, learn them, use them correctly, make money with them, and then you have this vast majority that take them, run with them, and just fuck themselves up all the high heaven. And it's kind of like with algo lines. It's the simplest thing in the world. This is how to draw them. This is how you put them in. Boom. And it causes a conniption fit with everybody. And what got me thinking is that, okay, should the 1 in 10 person who knows this and gets it and is able to get it correctly be punished because the other 9 have an odd number of chromosomes? No, maybe, I don't know. But at the end of the day, I'm just going to write down knowledge as I see it, and people will do with it what they will. So there will be some advanced methods. Dave is always experimenting. Pete's always experimenting. The great thing about Real Day Trading, the great thing about the One Option chat room and everything we do is nothing gets released to anybody unless it's been tested and tested and tested and tested and tested, and we know it works. We don't just throw ideas at the wall in public and say, okay, we're going to try, short strangles on after earnings in, during the FOMC. We do so many trades in the background, and many of them don't work out, and many of them do. And then we use that method over and over again. And when we have a long enough database to say, okay, through various conditions, through their various times of the year, over 100, 200 trades, we know this type of method will produce profitable results. Only then does it get released. Only then will you see a trade like that made, right? Dave had the time spreads, for example, but he was doing time spreads for well over a year before I remember he would IM me and say, I'm doing this time spread before anyone even heard of them. And only after hundreds of those trades, and he saw, okay, this thing has a win rate of, 85%, whatever, then finally introduce it. You go to anywhere else in the trading world, and people just throw ideas against the wall because it worked once for them. Their scratch-off ticket paid off. We don't do that. I feel that if you're here and you're trying to learn how to be financially independent, at the very least, we owe you the giving you information that we ourselves know and are confident is correct. If we're not confident that this thing, if used correctly, now I can't go in and change your mindset, but if used correctly will make you money, then yeah, that you won't hear it from us.
If by chance the Fed comes out and they are dovish and they start talking about moving up the timeline for a rate cut, then you're going to want to be in interest rate sensitive stocks. The home builders would be one such example. And you can see DHI had a big drop. It's back above the AVWAP-E, and it's putting in a nice little day here today. There's a good chance it will rally higher. RKT would be the same. That's Rocket Mortgage. So they would be writing more mortgages. That would be beneficial for home buyers. So you can see how it's tested this breakout here, well above the moving averages. The breakout, AVWAP-E, looking pretty good, plenty of room to run. So I'm not advocating those stocks. I'm just telling you where to look if the Fed happens to come out with a dovish statement.
And you never know what, for example, Powell himself has never really uttered the words rate cut, right? He's answered questions on it, but he's never volunteered rate cuts in his speech. Just the very mention of it might be seen as dovish, right? The lack of mention of it might be seen as hawkish, depending on what they expect right now. So wait and follow the price action afterwards. I don't think either Pete or I are really expecting that big of a post FOMC move. That will come more in March when there is some realistic expectations for a 25 basis point rate cut. And if it doesn't happen, that might, be seen, because you have two different things. It used to be a year ago or so, the actual Fed decision on raising rates was the mover, right? And then afterwards, the press conference would either add to that move or throw cold water on it. Now the expectation is obviously there's not going to be a rate hike in their decision, and it's too early for rate cuts. So the actual decision itself isn't the mover. It is the general minutes and Powell's interpretation of the conversation that the Fed presidents have that will be the mover. Are they leaning more dovish? Meaning, are they leaning more towards we're going to start cutting rates sooner? The economy is strong. We're good. We can go in and cut rates here and not worry about inflation popping up again. Or are they going to say the economy is too hot right now? It's too strong. And if we cut rates, inflation's just going to come right back like bacteria if you didn't finish your dose of antibiotics. So, the main thing they're concerned about is the not leaving behind a legacy of stopping inflation too soon. We have a question here, which is, hey guys, thanks for the live. Been following you for over 2 years. Based on my experience for the last 1.5 years, the wiki is just not a good guide or rule book for someone who only cares about growing a small account over PDT. All right, you have shown this by not making work with the past 2 or 3 5K challenges. So my question is, if you had to, how would you take a small account PDT via the wiki or adjustments to the wiki? Do you flat out think it's not possible, which I understand? That's a good question. And I'll answer. I've said many times that if you want to trade your way to growing a small account, 3 to 5K, it is very difficult. I've shown that. I've done it a few times, but more than half the times I did those challenges, it just didn't work under 5K. I've said many times as well that there are ways to grow it. It's just not exciting. And it's right there in the wiki. You can do bullish put spreads, right? You can just do 2 bullish put spreads, 2,500 each, a 5K account every month. Grow the account that way. You will grow the account by 1,000 to 1,500 a month until you start moving up, and you can do 3 bullish put spreads a month, and so on. Pete did this once with an account, strictly bullish put spreads. Not an exciting, challenges are, can you trade an account? Can you actively trade an account? And the problem with actively trading small accounts is that if you want to make a dent and you want to move it up, you have to have a large enough position size to do it, but then you don't have any room for error, right? So unless you're in a straight bull market, and many times I did take the 5K count, turn it into 30 and so on, which these straight bull markets where you have this clear trend, in which case you can take the larger position size and the risk pay off. But if you want to grow those small accounts, then trading it up is generally not the best way to do it, because again, you'll have to increase your position size to make a dent. Otherwise, you're going to look, oh, I'm at 55,000 today, I'm at 5,200 2 weeks from now, and then because you're doing one contract or 10 shares and so on. But if you use passive income methods like out of the money bullish put spreads, or if you could sell puts, which is difficult with a small account as well, it becomes an easy way to do it. It just takes a lot of time. It's not exciting. It's certainly not conducive to a challenge, right? It's like, hey, I did 2 out of the money bullish put spreads this month. There's your challenge. It works. That will work. It's just going to take you a long time to do it. And that is my advice, which is if you want to grow the small accounts, you need to use passive income methods to do it.
And keep trying and using one share. So if you're at $5,000, save your money. Wait till you get till $8,000, $10,000. And if you're constantly trading one share at a time, and you have to go with a brokerage firm that charges you next to nothing in commissions to be able to do that, and Tradier is one. $10 a month is what it costs you, so $120 a year. You just keep at it, and you keep adding your money to your account until you have a substantial amount of money to work with, and all the while you're getting better and better and better and better, so that when you finally are trading that account, you're going to be making really good decisions, and your win rate's going to be high, and then you're just compounding it. You're going to have to hold some overnights. You're not going to be able to day trade. So, those are the issues with a small account.
Absolutely. When it comes to options, do you ever worry that there are people trying to do multiplication division before they understand the basis, i.e. addition of subtraction work all the damn time? So many people take these trades where, particularly when they're spreads or time spreads or butterflies or whatever, and they have no idea how to get out of the position. They have no idea how options work. They don't understand the idea of premium. They're using out of the money puts and calls. Yeah, of course. But I mean, this is just a general problem. When I first started trading, and this was like 6 years ago or something, and got my ass handed to me several times, wiped out my account several times, I not only put myself through the exercise, I'm going to go to paper trading and I'm going to try every possible combination. I'm only going to see if I can make money going long on shares, only shorting shares, only using calls, only using puts, only until I was profitable, consistently profitable in every possible iteration. But one thing I had to do was understand inside and out the mechanics of everything I was trading. I would not trade it unless I understood the vehicle that I was using to trade. I was not going to trade calls unless I understood not just the idea of calls, but exactly what a call contract is, what it meant, why you made money or didn't make money, why the market makers put a premium or didn't put a premium, the relation of IV to that premium, all of it. I had to understand everything inside and out, and then prove that I can excel consistently using that method before I moved on. And if people would do that, I wouldn't be worried. But people don't do that. They just think, oh, calls, if things go up, calls are good. I'm going to do out of the money calls on Tesla because if it pops $10, then I'm going to make money here. Go to a casino, have more fun. You'll have a hell of a lot more fun in a casino than sitting there watching a Tesla chart. Go to Vegas, go to Atlantic City, go anywhere. Do that, because that's exactly what you're doing. It's just online gambling and it's not as fun. So having a deep understanding is necessary, but if more did that, then you'd have more successful traders out there. So I agree with you. It's just, that's the problem.
Stock
yes,
second, option. Market first, stock second, options last. Even if you trade options, and you don't have to trade options using this system. That is when you have mastered everything and your win rate is off the charts and you know exactly what you're doing. Then you want to use leverage and not before. But that's not what happens, because everybody hears that their neighbor just made 100% buying some call options on XYZ stock. And you've got all these gurus out there pumping and promoting how much money you can make trading options. Well, I don't have a lot of money. Good, because you don't need a lot of money to trade options. And so everybody just dives right in. They have no idea what they're doing, and they are led to slaughter. The worst thing you can do is buy short-term options that are at the money or out of the money, puts or calls, because you're not giving yourself enough time for the trade to work out. Even if all your analysis is perfect, you have time decay working against you, and one little market hiccup and you're toast. Don't do that. Just, even with a company called One Option, you would think everything that we do is related to options. Actually, we're trying to build a pyramid. First, you get the market right, then you get the stock right. If you don't do those two things correctly, you can do almost any option strategy and make money. But the key is, it's very difficult to get those first two pieces right. And that's what we're trying to teach you. All right, well, let's kind of wrap it up here pretty soon. I want to grab a bite and then be ready for the FOMC.
And just some general advice: if someone is bragging to you about their trading, don't listen to them. I mean, seriously, you all see what I make on Twitter and all that, and you see I've had, conversations every day with people. I don't bring up, oh, I just made this amount on this trade today. If your neighbor's coming to you, well, I just made this on Tesla, whatever, they're full of shit. Don't listen. You don't, just make that a general rule of thumb, that if someone unprompted, fine. If you ask them or question, and then they want to tell you, fine. But if they just come out and say, oh, I did this, and this, just follow the general rule that someone is bragging like that doesn't know a damn thing, and don't listen to them. Particularly that I just got, made $5,000 on call options on Tesla or whatever. Sure. And they're not telling you about, the car they had to sell to pay off all the money they lost the last month. So, just always be careful who you listen to. Make sure, whether it's in finance or anything else, make sure that the person you're listening to, at the very least, knows more than you. And, say what you will about and I have a lot of the former academic and a former person that used to teach at a university. I have plenty of critiques of the educational system, and I could do a whole podcast on that. But at the very least, in general, 99.99% of the time, if you walk into the classroom, the person at the head of the classroom knows more than you do about the subject they're talking about. And you can learn something from them. Now, there are better teachers and so on, but in general, they know more than you. And that should just be a rule, whether, taking advice or anything. Don't take a relationship advice from an incel. It's just pretty common sense, right? Make sure if you're listening to someone's advice, they know what they're talking about, and you can have some proof of that it's not just circularly based. They know what they're talking about because they say they know what they're talking about. There needs to be some evidence they do. Otherwise, you can just, roll your eyes and move along. All right. I think
Harry, is your pick of the week or the session Lulu short then?
I think I'm going to go with that, and I'm going to give credit here where credit's due to erratic snail, as funny as that is to say. I'm going to say that Lulu short is my pick of the week right now. It's at 458.76. So we'll revisit a week from now and see where it is.
And I'll put a caveat to that. It is not because you are bearish on the market, it's because it has a very good technical setup and we don't know what the reaction to the Fed is going to be. So the caveat is if the market is trading below the low of the day, then and only then would you consider Lulu as your short. And we are expecting the market to pull back a little bit. I'm expecting a cold splash of water from the Fed today. We're going to be gauging the depth and duration of this dip, brief and shallow, normal pullback within a bullish trend. If it's more sustained, we come down and we check the AVWAP-Q and this horizontal support level, then we know we have to be a bit more patient with our longs because the selling pressure is heavier. And so if that reaction to the FOMC is bullish and it's a nice reaction, I like RTX, and that is going to be my pick. I am in buy only mode right now. I'm not looking to short. This is a very strong trend. You can day trade short, but do not swing short. So you get caught and you will regret it. Trust me, because this is still telling me that there's a lot of buying out there. We'll see how things shape up. And thank you everyone for attending. We will see you next Wednesday. We plan on doing these events every Wednesday midday. Thank you. Good luck with your trading.
Bye, everyone.